Hey, before we get started with today's episode, I want to let you know that if you're planning for retirement or aren't sure where to start, we have a helpful checklist for you. We put together a guide called Your Pre-Retirement Checklist and have made it available for free on our website. This detailed checklist covers things pertaining to cash flow, Social Security, Medicare, asset allocation, and living a purposeful retirement. The link to download the checklist is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, enter your email address, and then you'll have access to your pre-retirement checklist. Thanks for listening.
Welcome to a Wiser Retirement Podcast, where you cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith. Guiding you to financial success are my co-hosts, Brad Lyons and Barnett. Hey, guys.
Hi, Casey.
How's it going?
So today we're going to talk about how to create your own pension. So many years ago, seems like, many people went to work for the government or a large organization. They received a pension, and that model didn't work out so well for the private sector. And so they created 401k plans along the way. Now they have like defined contribution 401ks where the company's maybe putting in 4 or 6% because they used to have a pension. And then you essentially are saving your own money going forward. That's how most people will be saving for retirement. It's just putting money aside for their future selves, right?
Right.
So how do we create that sense? I mean, I don't know, you can replicate 100% knowing that the U.S. government is going to send you a pension every month. I mean, that's Social Security. But if you're a government worker, there's a pension on top of that, right? So, you get your check every single month. You're not too worried about the government going out of business. But for most of us, that's not reality. And it doesn't mean it's a bad thing. You could have worked in the private sector and sold the business and now you have many resources. Or you could be an average American and have a couple $1 million. Actually, average American doesn't have a couple $1 million saved, unfortunately, but you could be an average client at a wealth management firm with a couple $1 million, right?
Which unfortunately you would need to produce some of these pension-like returns. So
yes. So let's talk to those people today. Those people who have worked hard, saved well. How do we create a sense of security for them going forward by replicating what a pension fund would do for their participants?
I think that's the right way to couch this whole conversation is to create or recreate what institutional fund managers do in order to create a lifespan for a fund like a pension that is almost infinite. Okay. And it's different from trying to create wealth starting at zero and accumulating and growing up to $1 million or $2 million, $2 million. Because the fund already exists. And so how do you manage this fund as a pension manager in order to match your current liabilities and your future liabilities to the current fund, the contributions that are being made to the fund, and what sort of return do you need in order to make all this happen? And all that comes into consideration when you're looking at a pension fund. The difference between managing a pension fund versus just managing a fund in order to maximize the return is that in a pension fund, you're also considering something that, your liabilities, which is not something you consider when you're simply trying to maximize your return. So as you bring liabilities into the conversation and into the investment management, what you're really doing is saying that next year, I know as the manager, I need to pay out X amount of money, and that's a liability. And the year after that, I need to pay out X amount of money, and that's a liability, and so on for year after year after year. So what pension fund managers use is two things. They look at the entire fund, they look at the contributions, they look at the expected returns that could come out of the different asset classes. In the same way that we do, we look at large cap and small cap, we look at international, we look at developing markets and emerging markets. We looked at fixed incomes versus equities and so on, and we come up with a expected rate of return. Okay. Now within that, that you have contributions being added and you have withdrawals being made. And so in order for all this to occur, what's the required rate of return? So let's say that they calculate it, and in pension world, it's somebody called an actuary. An actuary figures this out. They said, okay, given the amount of contributions that are being made on behalf of employees, given the amount of pension annuity payments that are being made out to the pensioners, if you get a 5% return on the fund, all this matches. Okay, so then the pension manager sets about getting creating a portfolio and constructing it through, techniques that allow them to have a high probability of getting a 5% return in this instance over the number of years that the fund is expected to be paying out these pension payments. Okay. Now, within that, you have these liabilities. There's next year's payment, the following year's payment, 10 years out, and 20 years out, and 30 years out for these employees that are starting today and are going to work for the next 40 years, for example. Now, this is called liability matching. And within a portfolio context, the way to manage this is you have assets that have a short duration for next year's payments, a little longer duration for 2 years out, 3 years out, and 4 years out. But those payments that aren't going to be made for 10, 15, 20 years, those are matched to assets that have a very long duration or very long lifespan. And we can talk about that a little bit later. But so they're within trying to achieve the required rate of return, they're also matching these liquidations within the portfolio to match the pension payments that are coming out this year, next year, the following year, and so on, with the duration of the asset itself. So it's a technique that pension managers use in order to accumulate, manage, and pay out for essentially an infinite time frame.
So that's step one in building a personal pension, is to making sure you have enough reserves. So what we don't want to do is have $5,000 in savings and $5,000 in checking, and everything else is just fully invested. And if you need money, you just pull money out of your investment accounts. So maybe you should even back up. Let's talk about how investment accounts even get there. So we have 401ks that roll into IRAs. We might have brokerage money that we've saved outside. But let's just assume that we look at it as one big IRA for now. So we have an IRA with $2 million in assets. And where do we start? We start by looking at what our expenses are. So if it's costing us, $100,000 to live, and let's say between husband and spouse, you're getting $50,000 in Social Security, that means you'd be pulling $50,000 out every year from the IRA, plus your tax liability. So let's say we're tax neutral for now, because you just adjust the percentages a little bit. We always talk with our clients in after-tax terms so that everyone knows we're on the same page, and then our software does all the back-end calculations of the actual tax liability, which is pulled out before we would ever send a client a penny, right? So what we do here is we create, we call them cash bucket or a cash bucket. We're creating 2 years worth of cash inside the portfolio at all times. Now, Brad, you work really hard to not actually keep it in cash. You're trying to find other instruments so we can get some better yield with.
Right,
but it's
but these
all
are
very,
essentially those short-term duration assets
yes,
that are liquidated first in the short term to match the near-term liabilities of those payments to the account holder.
That's right. So 2 years worth of income that's needed by the portfolio is kept in cash, plus a minimum amount that you keep in cash yourself inside a checking account or a savings account. And that money could be anywhere from $50,000 to $100,000 or greater, depending on your lifestyle. So for most people, I'd say it's somewhere between $50,000 and $100,000 in cash, plus 2 years of income need cash inside the portfolio. What does that do? One, it helps you cover and be ready for emergencies, which is the pension, right? If the pension had they probably don't have emergency withdrawals from a pension, but they could if all of a sudden there was lots of retirements, right? There's a retirement package being offered, which I'm sure they'd be consulted with.
That's right.
But regardless, if whatever the income need is, We know what that's going to be for 2 years. And so that's sitting in cash. Now, in the meantime, the cash plan is you have interest and dividends that are being paid out of the investments and into the cash account. So you're replacing your withdrawals, but not dollar for dollar. We don't live in that world anymore. We're planning on growth. So there's a portfolio strategy to manage all that on the back end. Essentially, it's buying high and selling low, right? At the high points, you're taking your gains and you're replenishing your cash. At the low points, you're spending down your cash. So that gives a strategy there of being able to withdraw money at the proper time. But another reason why you want to carry cash is just to protect you from you. So when the market does a COVID drop or there's a war that breaks out and the markets trade down, you don't want to panic and ever liquidate your investments. The pension company would never panic and liquidate their investments because they're concerned about meeting obligations in the future. I mean, they've planned for all this to potentially happen, right?
Yes, which goes to the time frame for the pension itself of being almost infinite, but at least 25, 30 years. And when we're looking at people living the longer lifespans that we live today, thankfully, we're looking at 25, 30 years on a retirement plan. So
right.
It's really the same. Our human brains, though, just don't allow us to think that far out.
Correct.
When we're thinking about ourselves. Okay. So it's a little more difficult, but we help people by counseling them and helping them to understand why we're taking such a long-term view and accepting the ups and downs in the marketplace as being a natural ebb and flow of investments.
So Matthews, when you look at doing a financial plan for a client, very often our planning rate is not the same as what Brad's trying to achieve in the portfolios. Do you know what that range is?
Of returns?
Yeah.
Usually the average retiree, like a 60-40, is only about 5.5% or so, which, like we said, is very conservative, especially if you look at the last few years. But long term, that's probably kind of what you're looking for a balanced portfolio. Probably one of the bigger questions we hear is, well, my granddad or my parents used to be able to get double-digit returns on this. Why can't I? And that kind of goes back to another question of just the environment we're in and how are they invested.
Yeah. So the 5.5% rate of return is what we're using to solve for rate of return going forward. Now, we do an additional couple other projections on top of that, one being called bad timing, and the other one, Monte Carlo. Can you talk about that a little bit?
Yeah, bad timing would be basically sequence of return risk. So that's probably retirees' biggest fear is that they retire during a recession or some type of bear market. So we'll run not only the good timing of that 5.5% with when I say balanced portfolio, I mean about 60% stocks, 40% bonds is probably the most common thing we see. But we'll run good timing, then we'll run bad timing where they retire and the market is down or their portfolio is down over 20%. And then the following year, it's down about 7 or 8%. So they were drawing from their portfolio for everyday needs while the market's down. That's called sequence of return risk because obviously it takes longer to rebound. And even during bad timing, we're making sure that they're able to reach their goals if the market corrected itself with that average 5.5% return throughout the rest of their retirement. However, we always like to say, life's not linear and the investments aren't either. So that's why we also like to look at what's called a Monte Carlo analysis. In the Monte Carlo, we run 1,000 different trials of stock and bond returns, take the median 500 on those to try to get the highest probability of success of reaching those retirement expense goals.
So we've taken into account 1,000 different possibilities, plus use a low rate of return. So I'd say that we've planned pretty conservatively, and just like a pension fund would do, Brad, right?
That's right. And by doing that, anything that we get above and beyond the planned rate, what we're doing is we're allowing that to accumulate in the portfolio to produce even higher returns going forward in the future.
Yeah, higher. Well, it'd be higher withdrawal rates. Higher withdrawal rates.
Right.
So we expect the returns to be greater than what we planned for. That's good planning. And then we've planned for these catastrophic drops in the market. So that's been covered. So that gives us a lot more, I don't want to use the word assurance, but it gives us more confidence that we're on the right path, that a major market disruption is not going to disrupt our lifestyle. And if it does, we even have this extra cash sitting here that's not really a part of our planning at all, that we're withdrawing from on a monthly basis. We got several phone calls during the COVID drop. I remember that, saying, well, you don't have to send me a check this month. I have some savings. Well, yeah, of course you have savings. We've already planned for you to have savings, and you don't have to stop your withdrawals, even though the market's down 30%, because we planned for this. We assumed this was going to happen.
And if you hadn't planned for it and you didn't have that realization, that's when you see people make the mistake of realizing those losses and either going to more bonds or getting out of the market completely and going to cash.
And we did have a couple people, I think we were able to talk them off the ledge for the most part, but they wanted to go to bonds, and that's not the time to go to bonds because you're buying bonds at all-time highs and you were selling stock at multi-year lows at that point. And that's buy high, sell low mentality, which we were all told not to do that, right? The joke is, hey, give me a stock tip. It's buy high, sell, or buy low, sell high, right? And everybody laughs and go, yeah, well, that's dumb. Everybody knows that, but nobody does that.
The idea.
Nobody does that. It's a problem. Human nature kicks in. Or, Vanguard was really happy during 2020 because people did nothing. Because in the past, people have reacted and did that. They sold stocks at lows and bought bonds at highs. And this year, they're very happy that they did nothing. And I thought, well, for a DIYer, that's good. You did nothing. But that's not what we did. We took action. We sold those bonds for gains at all-time highs, and we bought more stock when the prices were depressed. And it was just a rebalance. It was right inside everyone's risk tolerance, just like it's supposed to be. So there are times you take action. And that was a note from myself in 2008, 2009 to my future self, is take advantage of these situations. Don't be scared with your client base. You have to certainly be good listeners and understand the pain points, but in the end, we're here to guide, right? And that's our job, and that's what we get paid to do. That's the benefit of having advisors. So going back to our pension, so now we've created our cash system so we can meet all of our obligations, which happen to be our own in this case. And now we have to go build a portfolio. So we've got all of our cash set out. We have our 2-year reserve. We've got our emergency savings. How do we build a portfolio that looks like a pension fund?
Well, most pension fund managers utilize the public markets in order for investments companies, stocks, bonds, cash instruments. They use the real estate markets for long-term income payments from renters who buy into or rent from these large corporate headquarters or REITs or real estate investment trusts. Pension funds also have access to very large institutional hedge funds and or private equity funds, where the private markets, which allow them to push that return expectation out even further than in the public markets in order to have an expected return above and beyond the public markets for a longer period in time. So as they go out in time, the assets or investments that they make become more and more illiquid. So the shorter the time frame, the shorter the duration, the closer the liability, the higher the marketability and liquidity factors in those assets, the longer the time frame, the higher the expected rate of return, and the more illiquid the assets become. And they manage that on a year-to-year basis. So each year that they move forward, that illiquidity factor becomes more important. And so they begin trimming back on that. And they keep moving assets from the long term to the short term, with new money going out in the long term all the time. So it's a constant rotation of these asset classes based upon expected returns and liquidity.
So in terms of that, where do they start on the risk? Where should we start on the risk spectrum? Because you said private equity, that can be very aggressive.
Yes.
And you said, then there's just traditional like large cap stocks. So at this point, they know that what their obligations are, but they're not just doing a dividend focused strategy.
No, not at all. They're using a total return strategy. Total return is where you're taking income from the investment plus gains from the investment that you harvest through selling it at a high rate or when it reaches its high expected return. So you're utilizing both, capital gains and income, which is we use the term total return.
I think a lot of people still think that, when you're in retirement, we need to focus everything toward dividends and income.
Right.
And there is a strategy to that, but you've been very disappointed over the last decade.
And you have to have a lot of money to do it, because if you can't touch your principal or the corpus of the fund, you're only taking income. We've been in a very low interest rate environment for several years. So
that's true.
That just means you have to have a tremendous amount of money, which is very difficult for the average person to accumulate,
Yeah. So if the average portfolio yield today is probably what, 2.25%? Maybe less.
A 60-40 portfolio, we're looking at a little over 2%, which is higher rate of return than the S&P 500, which is a little under 2%. So by combining, fixed income assets, real estate assets, and stock assets or equity assets, we're trying to achieve a higher rate of return plus income for total return to match the expected rate of return or required rate of return that an individual is going to need to meet their own personal liabilities of income this year, next year, the following year, 25 years, 30 years out, et cetera.
Yeah, you would need a $5 million portfolio generating a 2% yield to generate $100,000 a year.
That's right.
Yeah. So now there are people with $5 million portfolios. We have a lot of clients that have that range, but that's not normal. So that's for most Americans, they're going to have to rely on stock market growth in addition to income. Mm-hmm. Doesn't mean that you're not touching. You are touching principal at times. You're just trying to keep up with the withdrawal.
Right. And you used to be able to have that in fixed income. You get higher returns than that and just live off the coupon and you were fine. But you can't do that today. Also, if you're going to take on the full risk to get those dividend yields from the dividend stocks, you're going to have to be invested fully in the market, which a lot of people can't stomach those ups and downs of those swings.
Yeah, true. So, all right. So we have a mix of large cap stocks, small cap stocks, real estate, foreign stocks, maybe some emerging market. That's a little difficult now. And then there is access to private equity if you wanted to fully replicate that. Not directly into funds, but there's fund of funds that own private equity.
That's right. And those are available to individual investors today. They have to be called accredited. As an accredited investor, somebody could, invest in private equity fund of funds, which helps to diversify a portfolio of private equity investments.
And then you got to manage your fixed income side. 40% of your portfolios are going to be in bonds. And so the default for, if we're doing a DIY pension fund is probably going to be like the U.S. bond aggregate, although I don't know if that's the best place to be today in the aggregate.
Well, it doesn't allow the investor to manage the duration of that portfolio because it's a fixed or set portfolio that it's right. That's the makeup of the U.S. ag itself. What we've done is deconstructed the ag, and so that we can manage the duration. We're in a rising interest rate environment now. Investors and portfolio managers have been expecting this for years. It's finally here, and so the portfolio needs to match the fact that we are in a rising interest rate environment. And as we know, as interest rates rise, the value of bonds can decrease in value. The interest rate, the coupon, remains the same, okay? But the value of the bonds can decrease. And we want to manage that valuation risk through managing the duration of the bonds between long-term, intermediate term, and short-term.
So for every 1% increase in interest rates, it's a seesaw effect, right?
That's right.
You're going to get a decrease in bonds. And I forgot what that ratio was. 10%. That's right. So every time interest rates go up 1%, you'd have a 10% decline in the value of your bond fund. Now, if you own individual bonds, that kind of doesn't apply to you, because if you're going to hold it to maturity, you get your principal. You always get your principal back at the end.
Yes.
But if you paid a premium for it, you're going to lose that premium by the time you get to the maturity date.
Right.
Now, in a bond ETF, what's happening is you're sorting through. So you have in the aggregate, at some point, the stocks are sold because they become short term, right? So the stock gets sold, but then new bonds are stock. The bonds get sold, but new bonds are purchased at higher interest rates. So it takes about 7 years for all that to sort itself out inside the aggregate.
It does, and that's the duration factor. So the shorter the duration, the less impact on the price valuation. The longer the duration, the greater the impact on price valuation as interest rates rise. And so by managing that, to the shorter end, you're getting a higher and quicker reinvestment rate at newer, higher rates.
Right.
As rates continue to rise, you can begin extending your duration, because by then, over time, those intermediate term bonds have begun picking up a higher interest rate, and so on out the duration scale.
So to keep it simple, what you could do is a short-term bond fund like BSV, and then you could add BND there as well to the portfolio, but maybe you're tilting more toward the short-term in BSV. Now, how we do it is we use BSB, BIV, and BLV, so short, intermediate, and long, and then we complement that with, right now, Treasury inflation-protected bonds and foreign bonds as well inside the bond portfolio. So you're able to pull levers to get the duration or the maturity date exactly where we want it in the portfolio. Some people are watching their bond portfolios every day, and that's why we always said, well, just do BND if you're doing this yourself, because you have to be able to pull those levers at just the right time, or you might be on the wrong side of the interest rate curve, right?
Yeah, that's why it's supposed to be the safe assets, and they were negatively yielding, which was tough for some people to wrap their heads around, of why when equities are down, bonds were still down, and why you're even investing in bonds. And it was, like you said, that long-term play that you're having to invest on the fixed income side for the long term and anticipate these changes.
Well, the main reason you buy bonds today is the fact that if you're 100% stock, you're probably not going to stomach this volatility. So that's the reason. That's the only reason I see anybody owning fixed income today.
Right. It's to mitigate the risk of investing in equities, the volatility of equities. So really, instead of getting much income, you're getting stability in the portfolio.
Right.
So,
right. So that could be a whole podcast in of itself, is why you invest in bonds.
Yeah.
But going back, keeping to our theme today, is we're building our own pension fund. So now we have bonds, 40% of the allocation, and then we have stock, which is 60%. I say on the stock side, there's a pretty good case for sticking mostly to U.S. large caps, and you could do that, and you could do that through some different flavors of portfolios. But this most simplest way to do it is the S&P 500, which you can buy the VOO, which is Vanguard's S&P 500 index fund. You can complement that with a short-term stock fund.
Right. And the reason you would do that is because the return correlations, aren't exactly 1-to-1. So as large companies move in one direction, small companies can move in another direction, or at least non-correlated. And so you're evening out your return stream if you're involved with taking withdrawals and trimming those positions in order to create cash for your upcoming liabilities.
So REITs. So is it VNQ? Is it Vanguard's?
That's the U.S. REIT fund.
U.S. REIT.
VNQI is their international REIT fund. So yeah, by investing in REITs, what you're doing is you're investing in real estate investment trusts, and as an investment and as a IRS sanctioned organization, tax wise, they're required to pay out 90% of their revenue or income stream to their investors. And so they're used as a bond proxy with the opportunity for capital gain at the same time.
Right. All right. So what else can we add to equities? I mean, we've covered foreign Probably do a light dosage there. Maybe no more than 10% of the 60%, or 10% total of the portfolio
in foreign.
Yeah.
Sure. Yeah. Yeah. Not a whole lot, because, the movements that are made in the foreign markets can be dramatic. And so it doesn't require as high of allocation towards it. Plus, what you're also getting from international investing is the currency differential. So you don't want to have too much exposure to currency risk, but you want to have enough so that you're protecting your investment from international currency swings.
That's a really good point. So you would hold foreign stock inside a portfolio, not hedged to the U.S. dollar. And so if the U.S. dollar declined, your foreign investment should go up in value.
Should go up in value. That's right.
And then that's the premise that large cap stocks perform the same way across the developed world. And so if you held if you're in Europe and you held foreign stock or your local stock in local currency, you get the same rate of return as we did on the S&P 500. I'd have to go back and verify that that's still the case. It was the case for many, many years. So the difference is the currency effect. Now, if you have declining dollar, or if you have a climbing dollar, increasing dollar, that typically is going to hurt bonds, right? So you can buy a foreign bond fund like BNDX, which is hedged to the U.S. dollar. So if the dollar goes up, you should have an increase in that fund, all things else being equal.
Equal, right.
So, then there's interest rate risk, obviously, in foreign countries too. So that's not dollar for dollar or an absolute for sure, but it does help. So that's a great way to hedge for dollars, for hedged U.S. dollars without having to be right on one side of the trade. And you're also getting paid income or dividends for holding those positions, where if you just bought a currency fund, it's not paying you anything. If you bought gold, it's not paying you anything. So this is a great way to hedge both of those but generate income, not have the portfolio hit because it doesn't have the income of a...
Interest rates don't move lockstep from country to country. And so by investing in international fixed income, you're allowing the fund manager to pick and choose or search out, if you will, those interest rates that are higher elsewhere than they are here at any point in time.
And you said something earlier too about bond or pension funds. They're how long are they around for?
Well, their lifespan is essentially, if you took it from they're essentially infinite, but it's from the youngest person who starts today, works for the company till he retires or she retires, and then lives with a stream of annuity payments for as long as their lifespan is. So you may be looking at, quite literally a 60 to 80 year lifespan of a pension fund.
So that's much like our own personal pension fund we just created.
It is. And from the first dollar that goes in to your savings account or your investment account or your 401k account until the last dollar is paid out when you've...
So our time horizon, people often say, well, I'm 65 or I'm 75 or I'm 85 and I don't have time to make up for this market. If this market falls off, I don't have time to make up the difference. And that's actually not how you should be looking at it at all.
No, you should just assume that, your fund, your pension fund personal pension fund, goes out for age 95 or beyond.
Yeah.
Quite literally. And the market's ups and downs are going to occur during that time period. And through our planning process, we recognize and acknowledge that these ups and downs do occur. We don't know when they're going to happen. We don't know what's going to cause them, but we know that they happen and they have enough regularity to them that we can expect that one or two is going to happen between these time frames, between when you start taking your personal pension and the time that you have exhausted it. You're done.
So that literally means focus long term.
Yeah.
Which promotes more equities in the portfolio than it does bonds. Honestly,
it just does.
It's hard to
because you have inflation that you have to consider as well.
Yes.
So it's not just paying out the same fixed income year after year. It's that income plus this year's inflation. so that you can buy that loaf of bread, you can pay for that gallon of gas, et cetera, that you going to cost you more this year than they cost you last year.
Right.
The real rate of return. We've been talking about nominal the whole time.
Yes, we have. Good point.
So that, again, it goes back to, you can afford to take on more equity risk in a portfolio because you have the time, or you should separate yourself from your investment. People don't look at the pension fund as theirs. They just see that check as theirs. The income is theirs. So that's partially how our mindset needs to be, is that the paycheck's mine, and technically the portfolio is all mine too, but I have to separate myself from that. We're going to build this investment, and it's going to pay me this income, and it's going to last through age 95 or longer. And then it goes back to our planning, right? We go back to our planning. We already talked about, we use a lower rate of return than what we would hope to get from that investment risk. We've run 1,000 different possibilities. We've assumed bad timing and that we lose 20%. Then next year we lose 7%. And after that, we only gain 5.5% per year. There's no rebound. But something else that we haven't really talked about is when we looked at that 5.5%, we subtract 2.25% for inflation. That's right there on in that what if worksheet that we use, right? So our real rate of return is really small. And of course it should be, because for planning perspective, because our entire reputations are built upon and no one running out of money before age 95, right?
Yeah.
So it's there's a lot less to be scared about when it comes to investing in this manner than people realize. And maybe we should focus on that more. That, look, this is a really safe analysis, a really safe strategy when you do this planning, versus some of these online tools. They allow people to put in 7, 8, 9, 10, 12% rate of return. It's all very linear. There's no safety margin built into the plan, right?
Mm-hmm.
So sounds like to build our own pension plan, we got to make sure we have enough cash, that we've done planning, actual portfolio planning, retirement planning, and then we've developed a diversified portfolio, which you didn't really allude to it yet, Brad, but we'd use ETFs, exchange traded funds, to replicate all that. So your pension, your personal pension, is going to end up with 6,700 stocks and probably about 10,000 bonds. Sounds like a great deal.
Yes, it does.
We just have to get out of our own way sometimes. But we can live with the notion that we can receive these monthly paychecks and not have to, we don't have to have the anxiety of sitting on the space rocket, like how we started this conversation, right? We can be sitting up there and it's just really cool. Like, yeah, we got this planned out.
Enjoying the ride.
Exactly. And maybe the view. It's probably a really cool view, yeah, if there's a window to look out of, I guess. All right. You can direct any questions to us directly here. You can always use our email. It comes to all three of us, education@wiserinvestor.com. Be sure to track us on YouTube. We have a Wiser Retirement channel on YouTube where you can watch this podcast live. Plus, we add several other educational videos throughout the week. A lot of those are done by Matthews each week. And be sure to like and subscribe online on the YouTube, and follow us or make a comment or a review of the podcast. Thanks, guys.
Thank you.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.